Hey everybody, this is Brant from Wolf on Wall Street Trade. Sorry if my voice and microphone sound a little bit different. This can be a little bit of a kind of a wrap-up video or review because kind of been making the case here for basically a couple months. What I do is I lay out my macro picture, what I think is happening in the economy, what's going on with rates, what's going on with the effective Fed funds rate, when that's hitting the economy, the lag, all that. And then I have kind of an idea of what I'm looking for in price. And then when I see that in price, it's kind of confirmation. And then I know what I'm looking for next in price. So it's kind of like building a case. So I want to go back to a video that was posted 4 weeks ago on August 13th. This is just a short little clip looking at the technology sector and what I thought was going to happen next in the technology sector. So let's go to that video real quick. And if we look at it from this perspective, there's two different things that could happen. We could get a little bit more downside and come down to like this 164 level in XLK, technology sector, or we could just stay right here basically. But either way, let me just draw something in for you real quick. I'm going to move this over, make some room. So when I say it's ironic that a bounce to a lower high could actually make a bigger topping formation, which would be a head and shoulders in this case. The volume is right for the pattern, and it's a kind of a particular volume pattern that you need to have legitimate head and shoulders. So far, it's right. So a tactical bounce could be played on the long side, but I do think it would probably be ironic that it would be making a bigger top. So I have the end of this video paused. Let me just kind of reflect back on this. XLK from where we were coming down to the 164 area, then a decent bounce up to the 177 area to be completed by the end of August or the start of September, and then starting to come back down, which would give us a big, this is kind of the neckline, sorry it's sloppy, but a big head and shoulder. So you have your left shoulder here, your head over here, your right shoulder over here. So I'm going to clean all this up. We're going to take a look at the technology sector right now, and this is the current chart. So what actually happened? It came right down to this 164 area. It bounced up to this 177 area by the end of August and is now starting to come back down. So I want to show you one more video clip. This is from 2 weeks ago, my video 2 weeks ago. And in this clip, what we are looking at is what I thought was going to happen next. So we had already come down. This is 2 weeks after that last, former clip. So we had already come back down and getting ready for that bounce. So let me roll this. So we're looking at the S&P 500 as of 2 weeks ago on August 22nd. So here's the clip. Perhaps what we'll get is a little bit more structure. Head and shoulders tops don't have to be symmetrical, but they often are. What I mean by more structure, let me just move this chart over, give us some space to look at it, extend this trend line a little bit. And what I mean is we kind of have almost two shoulders here, right? On the left side, and here's our head, and then we come back down to the neckline. So we definitely have one shoulder. What's interesting, this is 2.8% rally from the neckline to that high. Same thing right here. So it's exactly the same. Perhaps we get, something like this, and then we come back down to the neckline. And while I have this clip paused right at the end, if you watch the next couple minutes after this, I showed another scenario where we kind of came from here and came up to 45.50 and then back down towards this neckline, in any case making another right shoulder. So I'm going to clean this up, and I'm going to show you the S&P where we are now. So here's the S&P now. We got that rally, and we got it right up to about 45.50, which is right over here. And we are starting to come back down. This is our key reversal day that really was an ugly day, and right at the top of this potential head and shoulders, then this breakaway gap down right here. S&P on this rally did not even move into this breakaway gap. So that breakaway gap is very bearish. It's left unfilled, which makes it even more bearish. And when I get into what's going on here late in the week, as we move through this video, this is not looking good for the market. Remember that all this stuff, we were bullish on the market in October. actually saw the first change in character in August. Was not long or calling for long there, but looking for bases in October. We got bases in October. We've been rallying since then. So I've been bullish until the end of the second quarter, when we started to see distribution in a lot of the big tech stocks, Apple most notably, and I'll show you that. So it was about mid-June, and then we started getting all these trend breaks. So this is a 3C chart of Apple. Unfortunately, as long as the history is intraday on StockFinder, it's not quite long enough to fully scale this. But 3C was confirming, which means moving higher with price all the way up till this point here. This is mid-June right here. This is where we first starting to get negative divergences. Here's where we get this major trend break in Apple. But look at all this distribution all the way through, even into this latest rally, which tried to fill this gap over here. Didn't quite fill all of that breakaway gap. But this is one of the first changes in character we saw in mid-June, and now we're seeing a lot of these head and shoulders top forming. So for example, the S&P 500, we have left shoulders, head, right shoulder, have a key reversal day right there at the top, a bearish breakaway gap that's left open. If we look at 3C chart for SPY, the S&P 500, this is the head right here, and this is the key reversal day. So look how 3C is negatively divergent into the head of that formation. Here's the neckline. We have a positive divergence there, so we get this bounce. This is the right shoulder, negatively divergent into that as well. I'm going to show you a few other head and shoulders. They're in all the major averages right now. Let me go to the Dow Jones Industrial Average. We have a slanting head and shoulders over here. There's your left shoulder, head, right shoulder. This is this week, the end of this week. We'll get into that in just a minute. The NASDAQ 100. So here's a slanting neckline. This is a breakaway gap right here that I've just been highlighting for my subscribers, that bearish breakaway gap left unfilled. So we have the left side of the pattern here, the head, the right shoulder over here, the breakaway gap left unfilled, which is very bearish. And volume confirmation actually is really important with these. I'm going to go to QQQ to show you the volume confirmation. But basically what happens over here on the left side is not very important. But the rally to form this head, you should see volume declining on that rally, and then you should see volume picking up over here as price comes back down to the neckline. And on this rally to form the right shoulder, you should see the same thing, volume declining, and then it picks up as price starts falling. And then when it breaks this neckline, you see a real big pickup in volume. So let's take a look at QQQ for the volume real quick. So here would be our left shoulder. And remember, the volume over here doesn't really matter that much, but look at these green volume bars, how heavy they are, how high they are. But on this rally over here to form the head, look at the green volume bars. They are very low and they're declining. But look at these red volume bars as price is coming back down. They're much higher. And look at this rally over here to form the right shoulder. Volume is declining. So this is really textbook head and shoulders volume confirmation. And this is probably one of the most important aspects of confirming a head and shoulders, not just the price pattern. Here's IWM, or small caps, and this is actually the neckline. This is just something I drew in for subscribers because, like I said, a lot of times head and shoulders are symmetrical. So I just drew in a parallel line parallel to this neckline to give us an idea of where this rally would come up to about. And there it is. And look, it's already come back down. And then we have the Dow Transports, which is the only of the major averages that has got a head and shoulders in place, and it's already broken the neckline. Let me take you to the daily chart, show you the volume on this break of the neckline real quick. And you can see it right over here in this big ugly volume on a week that's really had very late volume. It was a holiday shortened week, so big volume as price broke down to that neckline, which is exactly what you want to see in head and shoulders. So volume gets really important from the rally that forms the head all the way to the rest of the pattern until it breaks down. On the left shoulder, it's not important. The head, the right shoulder breaking down, it's very important, and they're all pretty much pristine. I haven't seen this many head and shoulders in this many averages and important sectors with this stellar volume confirmation, as well as the 3C charts and market breadth, everything. I mean, there's really strong case here for a lot of tops in the market right now. So like I said, I'm going to show you what happened this week towards the end of the week. And it was a holiday shortened week, so I wasn't sure if it was going to be kind of a quiet week or if we're going to get something kind of interesting. We did get something kind of interesting. So let's go to those charts. So here's a 5-minute chart, the S&P 500. Again, it was a holiday shortened week, so it started right here. This 4,500 level broke, and look how it just really broke down. A small bear flag here. I thought that this bear flag would kind of broaden out the rest of the week, but Apple got hit again right over here, so that brought prices down. But then the bear flags did broaden out, so we have bear flags in all the averages. Started to break down a little bit on Friday. I'm not sure if these are broadening out again, and maybe the angle will change or not, or if they're going to back test into this and then just head back down to those necklines of those head and shoulder patterns. So there's the S&P. Here's the Dow, and this is a 3-day flag because Apple really doesn't have as much influence in the Dow as it does in the S&P 500 and the NASDAQ 100, where they're both market cap weighted, whereas the Dow is a price weighted index. So Apple is something like the 12th most influential stock in the Dow, but it is number 1 in the S&P, number 2 I think in NASDAQ, number 1 or number 2. In any case, bear flag here. So what I was expecting to happen did happen in the Dow. It was just Apple getting hit twice in a row and gapping down. So bear flag there. The NASDAQ 100, same thing, small bear flag. Apple gapped down again, brought everything down with it, and a little bit larger bear flag formed into the end of the week. Small caps with a weak attempt at a bear flag because just really weak price action. But we had a small one intraday here, broke down again, and this is kind of just a sloppy version of a bear flag. Here's the Philly Semiconductor Index. Again, bear flag there. Regional banks, let me pull those up real quick. This is a larger bear flag, and it comes out of a failed bull flag here. This is a bull flag that failed to launch. Failed patterns, fast reversals. So there it is, a bear flag. It jumped above one day. I said, watch this. I bet you it's going to come back down. It did. Broke below that bear flag. Maybe going to back test in here where it could be a good short again. But the point is, look at all these bear flags everywhere. A couple of trades I threw out. One was WBA or Walgreens Boots Alliance. So here's the bear flag. This is the day I brought it up right here to subscribers. I saw UNH breaking down pretty heavy too, but UNH was already broken from the bear flag as of the 31st. So this is like the better trade. This has lost almost 13% now since it broke down. So it well surpassed the measured move over here. Real ugly price action there. But point is, look at all the bear flags that we're seeing in the market. Here's United Health, which I had shown that same day, remember the 31st, but it had already broken down from this bear flag. But what I told my members, I said, this doesn't look as good of a trade because it's already broken down. It's already, almost all the way to the measured move. But I said, watch it for another bear flag to form. What do we have? Another bear flag right here in UNH, which is a top weighted component in the Dow. From the rally that started last October, right through June, July, probably a good part of August, I highlighted very few bear flags, saw very few bear flags. I'm not even sure before the end of Q2 if I highlighted any at all. We had a bunch of bull flags because we're in a bullish market. We have bear flags everywhere. We have head and shoulder top patterns in all the averages, and in Dow Transports, it's already broken. And we have these bear flags everywhere. That's telling you something about the character and the tone of the market. It is really changing right before our eyes. From the perspective of what I've been telling my members, my phase 1, which was the rally, phase 2, where the rally starts to turn and roll over, and we start to get into economic recession later this year or early next year, and that will eventually see a new bear market low, because we've never had an inverted yield curve, or the number of inverted yield curves we have now, fail to predict a U.S. recession. The 2's10 spread is the most inverted in 40 years. The 3-month 10-year spread, which is one of the Fed's favorites, again, 4-decade inversion. So that's forecasting a recession, okay? And the S&P has never bottomed before the onset of a recession. So we're just going with the probabilities here, and those are really strong probabilities, and we're seeing all this stuff in price as well. There's one other aspect that I do want to show you. So we have those head and shoulder tops, and those are just kind of like an exclamation point on the rally from the October lows. So if we're looking at a 4-hour chart of the S&P 500, this was a bear market right up until this point. The Dow actually had the nicest base over here in October, and it rallied the most into November. And then as we got into January, the mega caps took over and the NASDAQ 100 rallied the most. But prior to that, prior to January of 2023, the NASDAQ and the mega caps were like the most hated stocks of 2022. They rotated in. So we have this rally, right? And this is our head and shoulders top over here. That's capping off this rally. That's saying this is the end of this rally. Now, I don't necessarily think that, we're going to see a market crash or anything like that. I think, well, if you remember, I'm going to leave that stuff for subscribers, but I do think it is the end of the rally. We're getting there. We're getting towards the end of this rally, and a lot is going to change. What people have been used to, and a lot of people really didn't get long until the S&P broke out above 4,200, right in this area. This is where all the hedge funds that had record-sized shorts in S&P futures, never seen shorts that big in S&P futures, they started covering. All the retail started jumping in. Actually, retail had a little jump on the hedge funds. What you would call dumb money was actually a little bit smarter than the smart money. But few people were in back here in October with us, or even in January. This is more of a recent thing. So a lot of people are bullish here, and we have a lot of tops forming. So I think a lot of people are going to be caught by surprise. This is just one aspect, though. I want to show you on a weekly chart. So now we're looking at the S&P 500 on a weekly chart. This is the all-time high that was reached in December of 2021. This was actually our bear market. Here's our August low, and this is about where our little head and shoulders are forming. We basically have something that looks like a big double top as well forming. We don't have to come all the way up to this trend line for that to be a double top. So we have that in the S&P 500. We have the same thing here in the NASDAQ 100. If you look at small caps, they're not even close. And why this is important is because a lot of people are talking about, oh, maybe we're not going to have a recession, or it's going to be a soft landing. Okay, so maybe we're not going to have a recession. Remember, inverted yield curves have not failed to predict a U.S. recession. We have the most inverted curves in 40 years. If we had a soft landing scenario or no recession scenario, what stocks do you think would be doing the best right now? The small caps would be leading. All right, the small caps are lagging badly. And I want to show you something else from a little bit longer term, actually a lot longer term perspective. Here's the Philly Semiconductor Index again on a weekly chart. This is going all the way back to 1997, 98. Here is the top of the dot-com bubble in semis. Look at this monster over here compared to the dot-com bubble. So the dot-com bubble, we had the financial crisis over here in 2007, 2008 into 2009. This is basically called the everything bubble. Okay, now I'm going to show you one other. Here's the NASDAQ 100. So again, there is the tech bubble top. And this was a pretty massive bear market. It doesn't look like it right here. But compared to what we've got going on over here, my Lord, woof. I mean, if you can't see a difference in the trend here, even with the COVID crash and all that stuff, if you can't see a difference in the volatility of this trend, this is really, really ugly stuff happening right now. So I'm going to leave it at that. And we'll pick it up next weekend for subscribers. Of course, I'll see you tomorrow. But if you're interested in subscribing to the website, the new website's going to be online. I hope to have it online this weekend. but it looks like probably by next weekend. So if you're still interested in subscribing, you haven't checked it out yet, you can subscribe to Wolf on Wall Street Trade, the current website, at the 2008 rates. The new website's going to have a lot of new features, a Discord room for members. Its price is going to go up a little bit, but if you are a current subscriber to Wolf on Wall Street Trade, by the time I migrate everybody to the new website, you are grandfathered in at that 2008 price, so you're beating inflation, and you're going to help yourself beat the market. I'm going to help you beat the market, because we're not like getting in on these trends 6-8 months later. We're seeing them in advance, marking things, saying they're going the way we think we're going, and we are on them as they are changing, not 6 or 8 months later when you basically miss most of the move. So everybody, enjoy what's left of your weekend and have a great week. And subscribers, I'll see you tomorrow morning.